a
Let
minute.
me cut this off. Hold on, guys. Okay, here we go.
Raheem, is it possible you could wipe your screen a little bit?
Yeah, of course. Yeah.
All right. Well, good afternoon, everyone. I'm Michael Campbell. I'm the founder and CEO of the Street Smarts. And we're just really, really happy to have you all here today. And especially since our speaker today, which I'll speak on in a couple of seconds, is an alumni of the Street Smarts. And he knows I'm proud of him. So you'll learn more about him in a second. So couple things. If you have not, please become a follower of the Street Smarts on LinkedIn, because we're trying to get up. I think if we get close to 1,000, we'll be able to get our LinkedIn live page. And then again, we are, if you want to get a little swag, you can go to our website and go to the, I think it's shop, okay? So before we get started here, I would like to thank our sponsors. And our sponsors are Pincera Securities, Kingsford Capital Management, Beneficial State Bank, Bivium Capital Management, Westpac Wealth Partners. Stop that phone. Westpac Wealth Partners, excuse me, and that's Jermaine Carter, IEQ Capital, and last but not least, Capital Valley Fund, CVF Fund, Capital in Davis. Ladies and gentlemen, your host, Brahim. You're on, buddy.
Hi, everyone. So I'd like to welcome you to our fourth presentation, the Street Smart Summer Finance Program. My name is Brahim. I'm an incoming senior at SF State University, and I'm studying finance. My role in TSS is I'm on the junior board as well as a program specialist. Part of being a program specialist was creating this program and sourcing speakers, among those being today's private equity and fintech, which is coming in about 2 weeks. And before we start, I want to tell you more about private equity. So private equity is the ownership or interest in equity that is not publicly listed or traded. And in 2019, public equity had about 3.9 trillion in assets held by such firms. Before we start, I do want to hand it back to Michael for this. He has a few things to say.
There we go. Good. Thank you, Brahim. You guys, I'm just really, really proud to have Ben here today. I've known Ben since 2017. He was on our first class, and he has just excelled, and he's now in private equity where he should be. He is a really, really bright young man, and now he's given back to the Street Smarts. And Ben, you know I love you, buddy. So go for it, and I'll be off camera.
Okay, sounds good. Thanks for the introduction, Brahim. Thanks, Michael, and thanks for putting it all together, Leon. So like Michael and Brahim said, I'm actually an alumni of the Street Smarts, so I'm super excited to be back and paying it forward to you guys and helping you guys learn a little bit about private equity and how it works. So a little bit of background about me. I was born and raised in Redwood City, went to Woodside High School. I know there's a couple of you guys from Redwood City, so we can have a little side together. But other than that, after Woodside High School, I went over to Cal Poly to study finance. And then my second year, I was introduced to Michael Campbell by a good friend of ours, Rio. And Michael was extremely generous with his time and he was able to introduce me to people that have been very influential in not only my personal life, but also my professional career. And then from there, he was able to introduce me to Lucha Capital, where I was able to intern my sophomore year. They're a TMT-oriented hedge fund out in San Francisco. So gained very valuable experience there, working alongside Marcelo, who was just a wonderful mentor, and again, just very generous with his time. From there, I entered my junior year, and I thought, hey, to be able to kind of value companies better from the outside, I should probably learn how they run on the inside. So my junior year, I interned as a financial analyst at Yahoo. So I was covering the sports division, learned a little bit more about the internals and kind of how everything runs inside of a company. And then my senior year, I got lucky enough to stumble upon the opportunity at CBF and kind of pounced on it. And now I'm working alongside just great management teams and working alongside great managing partners that help me excel and learn a lot. So I think I'll share my screen. Can everybody see that? Brahim or Leon, is that good?
Yeah, that's good. I can see it.
Cool. Okay, so like Brahim said, I'll be talking a little bit about private equity and showing you guys how it works in the landscape overall. So this is the agenda. I'm just going to close this a little bit so I can see it better. So the agenda, we're going to start talking about just companies in general, what directions they can take, whether it be raising capital or self-funding. And then we'll talk a little bit about the private equity landscape and the M&A landscape and how private equity fits within the M&A landscape. And then we'll get into kind of more the nuances of private equity and talk about really how we make money, what we're looking for in investments. And that also kind of flows into part 3, which is deal candidates, which I'll talk about what we're looking for in investments and what makes a company kind of eligible for private equity or be a good candidate for private equity. And then I'll go into the process, going from kind of the teaser, NDA, all the way through to closing a deal. And that'll help you kind of lead into the basic private equity model, where I'll share my screen and kind of walk you guys through what a typical short form model or kind of like a basic private equity model looks like, and how you kind of value a company and back into the returns. And then we can open it up for Q&A. So I'll just jump into kind of the first slide. So I did want to touch on company paths and give a little bit of a background in terms of what companies can do when they're starting out and kind of how to manage themselves. So they really have 2 options. One, you can self-fund yourself, and the way to do that is you can either, as an entrepreneur, you can invest your own personal wealth. That's one option. You can run a company that's negative net working capital. If you guys don't know what that is, that's just you get paid, essentially, just distilling it, you get paid before you have to pay others. So that happens sometimes with like software companies where they'll get an entire year's worth of annual recurring revenue up front, and then they'll have to spread out the costs throughout the year. That's very uncommon, so I wouldn't focus too much on that. And then the third option for self-funding is just running it straight out of your own cash flow, or running a company that's very profitable is essentially what that means. The other option, and the more likely option scenario, is that at some point throughout the company's process, they're going to raise capital, whether that be at the start or once an entrepreneur is kind of gained traction and is looking for a liquidity event, or just a partner to grow quickly. They'll likely be going out to raise some kind of capital, and that can be anywhere from debt to private capital, which includes like venture capital and private equity. Or they can go into the public market, which would be kind of the IPO, but there's also things that people have kind of developed in the last 10, 15 years, which are SPACs and direct listings. So going across kind of the company stages, I wanted to show you guys what the options are for entrepreneurs as they kind of go through the company's different stages. So at the startup level, what that means is pre-revenue usually, or has a little bit of traction, but really there isn't any profitability, or it might just even be an idea at the moment. At that point, there's VC funding. So that's either seed funding or Series A, or investor or angel investors. Or again, you can go sometimes for venture but that's a little bit early on, or you can run again negative net working capital. But that's not often. From there, you kind of see the early stage, which would be you start to gain some traction, you have some revenue, unit economics start to look a little bit like they make sense. And at that point, it's similar. You have VC funding, or you can get usually venture debt, maybe some debt, depending on how your economics are looking. But by this time, you're probably on the radar of your competitors, and competitors might swoop in and pick you up. And that would be kind of corporate M&A, which the companies that are your competitors are looking to gain some synergies or kind of stifle your growth because they see you as like a competitor. So they might buy you out at that point. Moving kind of more into the later stage where you really have revenue traction, and your unit economics start to make sense. At that point, you start to have like late stage VC, which often will invest just kind of right before going public, just kind of give you bridge capital between. Or there's again corporate M&A that we just talked about. And really in the later stages where you start to get into the availability of private equity. I guess VC is, just for nuance purposes, VC is a subsector of private equity. But in this presentation, I'll kind of differentiate between the two, because venture capitalists are looking for completely different looking companies than private equity. And we'll go into that later. But in the later stage, you're also looking at potentially IPOing, and you can likely start to see corporate or just regular debt that they'll lend against like the assets of the company or the cash flow of the company. In the mature stage, you have every option when it comes to capital. So you'll see you have your IPOs, your SPACs, direct listings. So that's just taking the company to the public markets. You'll also have the availability of private equity as well as debt, and you can do potentially a dividend recap. And that at the mature phase, you have revenue obviously, and you're starting to cash flow depending on your company, on your company's kind of stage and industry as well. So now that you kind of understand the stages of companies and the availability of capital between the different 4 stages, I'll talk a little bit more about the M&A market as a whole, and then kind of drill into the private equity. So private equity fits inside of the M&A market. And as you'll see there, private equity tends to be about $800 billion of transactions annually, doing about like 5,500 deals every year. But if you look down below, the corporate M&A market, which we talked about, is like, say, Apple buying Netflix or something along those lines. That tends to be a much larger portion of the M&A market. That tends to be about like $3.4 trillion annually compared to the $800 billion that you'll see in the private equity markets. And the two are a little bit intertwined also, because private equity companies can sponsor corporate M&A as well.
Hey, Ben, we have a question.
Yeah.
What is the dividend recap?
Yeah, so a dividend recap, and I should have touched on that, my apologies, is say you have, like, just for simple purposes, you have no debt in the company, and you're 100% just funded through cash flow or equity investments. Once you become a little bit more mature, you'll have lenders that are willing to lend into the company. And so you'll get the cash from the lenders, and then you can distribute that as as a dividend and essentially a distribution to your equity holders. So that's what a dividend recap is, just kind of simply.
There was one more question from,
Yeah.
Do you see coronavirus accelerating private equity and M&A activities?
So the answer is no. The deals have kind of slowed down just given the proliferation of of uncertainty, and that makes it very difficult to take a perspective as the long-term picture of a company, and that makes investing slightly harder. And likewise, a whole portion of making an investment includes like meeting management and like seeing the company, and that's also very difficult in the current environment. So the answer is no. But when you look at like the VC stage of private equity, there is a lot of investments going out because there's just such change going on in the markets that entrepreneurs are starting a lot of companies and looking for private capital. And that's at the VC stage. So private equity has slowed down. I'd say that venture capital is maybe flat, if not down also. And then corporate M&A is also down. So people are really kind of just hoarding onto cash and making sure that they can get through the times. So turning to corporate M&A, some of the characteristics of corporate M&A and the reasons why it tends to be larger than the private equity portion of the M&A market is corporations are usually willing to pay a little bit more. So your multiples, which is kind of the valuation of a company, tends to be higher because these deals are strategic, right? So the corporations are looking to drive synergies with the companies that they're buying, whether that be scope or scale or kind of vertical integration. They tend to be able to pay more than financial sponsors such as private equity firms. So you'll see a lot more corporate M&A going on than the private equity space. And then also when it comes to corporate M&A, once you get into the big deals, there's occasionally government involvement. You've seen a lot of that lately with Facebook and Apple and Google having to sit in front of Congress. I think it was a couple weeks ago. So there's just kind of the differentiations between corporate M&A and private equity. When it comes to private equity and the private equity landscape, usually we kind of try to tranche it out differentiate between the different private equity groups based on company size or target company size. So you'll have the lower middle market, which tends to be deals in the $5 to $50 million of revenue range, doing 1 to 10 million in EBITDA. And for those of you who don't know, EBITDA is earnings before interest, tax, depreciation, and amortization. And that's supposed to be a proxy for cash generation of a company, but really it's not. It's just a metric that everybody tries to follow just to kind of make everything match between the different markets. In the lower middle market, you'll see that it's typically like family-owned businesses or family-oriented businesses. There's often no formal board, but again, there can be very formalized companies inside a lower middle market, but typically they're not all too formalized, and that leaves a lot of opportunity, right, for financial sponsors like ourselves who are in a little lower middle market to be impactful and kind of let the generations be like passed on or allow for a lot of change within a company. And then kind of moving up the ladder there, you'll see that you have the middle market, which is typically $50 to $500 million in revenue, 10 to 100 million in EBITDA. And then you start to get a little bit more formalized. You'll have audits, and we try to implement audits at the lower middle market, but when we're entering an investment, there typically isn't audits. But as you move up, you get more and more formalized. And typically, as you go up this ladder as well, your valuation in terms of your EBITDA multiples tends to go up because they're kind of deemed more safe in a way as you get bigger, and there's more capital seeking those markets. So there's other classifiers when it comes to private equity groups, including like industry specific private equity groups. So they can target specifically, say, technologies or industrials or transportation and be industry specific. You can also be region specific, like CBF. We tend to target companies that are west of the Rockies, or you can target certain continents, certain countries, certain territories, states, whatever it is. Private equity groups tend to differentiate themselves by region. There can also be mission-driven funds, so that could be funds that are looking to make investments in lower income communities or developing countries, or whatever their mission is. They try to differentiate themselves that way. And then there's strategy specific private equity groups as well that tend to focus on one strategy, whether that be like management buyouts or a take private, which means like they're buying a company from the private market or from the public markets and taking it private into their private equity group. So yeah, there's a bunch of different kind of classifiers within the private equity groups that private equity tries to differentiate themselves by using. I think there's a question. What is the purpose of private equity? So I'll get into that a little bit right now, and then I'll talk about it more later. So the purpose of private equity is to provide capital to companies that are looking for a liquidity event or looking for expansion capital. So say your mom or your dad owns a business and they are looking to retire, and you're kind of the successor to the company. And your parents kind of want to have some chips off the table just to make sure that you don't mess up or something, right? What they'll do is they'll be like private equity backed. They'll look for a private equity sponsor that will put investment capital into the company, and then transition the company over to you. And by doing so, by being backed by a private equity company, they'll have like a liquidity event where they'll get some cash out of the company, and at the same time be able to pass it onto the successor. So that gives a little bit of a grasp on private equity. There's also like expansion capital, where a company wants to do a big marketing campaign or thinks that they want to expand into certain territories. They'll look for expansion capital because they don't have the cash on their balance sheet to go and spend the money to kind of grow. So you'll see private equity groups come in and kind of provide that liquidity for a company to grow. And then there's also the situation where there's a private equity group that already owns a company, and they have to sell the company because they're in their fifth year of their investment or seventh year of the investment, and they need to get out. So they'll look for another buyer, or the management team will partner with a private equity group to buy out the previous owners. So I hope that answers that question, but let me know if there's anything you guys want me to dig into a little bit more with the purpose part of private equity. So going towards CVF Capital Partners, I wanted to kind of show you guys how private equity groups would distinguish themselves just by kind of running you through CVF, which is currently where I work at. So we're region specific. We look at companies that are west of the Rockies, and we focus on mezzanine capital and preferred equity. I'll stop there for a second and talk a little bit about like the capital stack. So in terms of, let's see, equity upside, I'll talk about that in a bit. When it comes to the capital stack in a bankruptcy, just for simplicity, you have your senior debt, which is secured typically by some kind of assets or cash flow, and they are the first liquidation preference. So they get paid first in a bankruptcy. So let's say we have a company that when it goes bankrupt, its assets are worth $100 million, and you have $40 million of senior debt. your senior debt is going to receive that $40 million of their principal and any accrued interest. And because they're the first liquidation preference, they're technically the lowest risk, and because of that, they'll also need the lowest return, or require the lowest return. And then below the senior debt, you'll have your mezzanine capital, which tends to be just subordinated debt. That's the second liquidation preference below the senior debt. So in that same bankruptcy situation, let's say it goes that there's subordinated debt of another 40 million. So below your senior debt's already been paid off. The next 40 million will go towards the mezzanine capital stack, which would be your subordinated debt, and any accrued interest that they have as well. And then below your subordinated debt, you'll have your preferred equity, which is, I guess, the third liquidation preference. And they're more equity driven, but they'll typically have some kind of preferred return or liquidation preference ahead of the common. And because they're all the way down at the third, they have a higher risk and therefore require a higher return as well. And then you have, after all those are cleared, then you have your common equity, which is kind of the last person to be paid out in a bankruptcy and the last person to be paid in a liquidation event as well. So that kind of walks you through the capital stack. I just want to make sure everybody is understanding what that is. And where CVF sits is we're a preferred lender, or a subordinated debt lender, as well as a preferred equity investor. So we'll take the position in mezzanine capital stack. What we're looking for in companies is $1 to $7 million in EBITDA. So again, that's the lower middle market, with $10 to $100 million in revenue. And we can stroke checks from $5 to $20 million, but we can do deals that are upwards of that just by having co-investors. And again, that $5 to $20 million does not include the senior debt in the capital stack. So you can also include senior debt in there, and co-investors as well. So we, like I mentioned, we're region specific. So we target the West of the United States. And what we're looking for are quality managers or a quality success plan. And we'll do any kind of transactions from dividend recaps, like we mentioned, or recapitalization of their balance sheet. We'll provide growth and expansion capital. We talked about that a little bit. We'll also do management buyouts, or ownership transitions, like we talked about, the parents looking to transition over to their daughter or son. And then we'll also provide acquisition capital. So if a corporation is looking to buy another corporation, then we'll provide some of the capital in that capital stack to aid in that investment. So any questions on that before I move into private equity structure? Let's see, what is equity upside? So that's, I'm not entirely sure what you're looking for there, but equity upside, I think of what you're asking is, like, how do we make our returns? And I'll talk about that in a second. So how are private equity groups structured?
I have a question real quick.
Yeah.
The question is, can you talk about how your firm evaluates the managers?
Yeah, and I'll talk about that a little bit more. So I'm going to in a couple of more slides, but I'll touch on it now. Essentially, we're looking for management that's dedicated to business, whether that be they're extremely well-versed in the industry, or say they started a company and they know every player in the industry. So that's one thing that I'd talk about in terms of the quality of the managers. The second is just being a good person. That's definitely something that we're looking for in our managers, because we think that's a reflection of not only ourselves, but also of the team that's below them. Second is a good understanding, or third is a good understanding of their numbers, and their operations below them. So being an effective manager, and being able to kind of manage the people below you, is something that we're looking for. And fourth, they have to have good perspective on what the market looks like moving forward. So they have to have a good understanding and grip of how to push the company strategically forward and grow the business for themselves and for their private equity backers.
And there is another question. So who fronts the senior portion in the last chart touched upon?
Yeah. So that's a typical bank. That's typical bank debt. So say your Wells Fargo's of the world, or your Comerica's, they'll be the one that is fronting that senior portion of the debt. And that senior portion of the debt, like I mentioned a little bit, is typically backed by some kind of assets. And if not, say it's a very lean business and they don't have any assets, it'll be based on the cash flow of the company. So hopefully that answers that question. So talking a little bit about the private equity group structure, I wanted to talk about that for, say, anybody that might be interviewing for private equity. Essentially, the way it's structured is you have, I'll start in the top right here. You have your LPs. So those are the investors into the private equity fund. So LPs are limited partners. They're limited to the capital that they commit to the fund. And you pool all of those limited partners into what the private equity fund, which you think of as like the investor into the companies. And that's a limited partnership made up of all the LPs up above, the investor one, investor two, investor three. And the private equity fund is managed by the general partnership and the management company, as you'll see here. The management company kind of dictates how the private equity fund is run and the investments that they make. In return, the management company will get management fees, which we'll touch on in a second. And the general partnership, which is the sponsor of the deal of the fund, will get carried interest, which we will also talk about in a second. And the private equity fund, based on the discretion of the management company, and typically the management company and the general partnerships are commingled in a way. They'll be making decisions into what companies to invest. So at the private equity fund level, you're making investments into different companies. So say a company that makes tires that we'll talk about, ABC company. We'll make an investment into those companies, and you aggregate all those into what is called the private equity fund. And that, what happens when you want to make an investment into, say, investment one, is at the start, all the investors, investor one, investor two, investor three, they don't actually front you the money. They don't put the money into like a bank account. What happens is we go and we want to make this investment into investment one. We'll tell all investors, hey, we're going to make this investment into investment one, and we want to call X amount of capital for investment one, and you'll take that pro-ratably or pro rata through investor one, investor two, investor three. So just to give an example, say we're making a $100 million investment into investment one, and investor in our private equity fund is a $1 billion private equity fund. Investor one is committed 10 million, investor two is committed 20 million, and investor three is committed 300 million. So 100, 200, 300 million. The way that we'd call the capital would be pro rata, right? So we're making a $100 million investment out of a $1 billion fund. So we're going to pull 10% from each of those, or 10% of the capital committed from each of those investors. So the first investor will provide us with 10 million. The second one will provide us with 20 million. The third one will provide us with 30 million, and so on and so forth throughout all your investors pro rata. So that's the private equity structure. Is there any questions on that? I don't see any. So I'll move on to the private equity economics. So like we mentioned, the management company gets a management fee. And what that typically looks like is for the first 5 years of the private equity fund life cycle, that tends to be 1% to 3% of committed capital. So that's not, again, like I mentioned, they don't just put all the money into a bank account up front. They kind of hold it on their own balance sheets until we want to call the capital. But throughout that 5-year investment period, you get 1 to 3% of the committed capital. So $100 million fund annually, let's take the average of the 1 to 3, 2%. We're getting $2 million in the door to cover, say, like my salary or the office space that we rent. So that's one aspect of the management fee. And then after that investment period, which is typically 5 to 7 years, depending on your fund, your management fee then transitions over to usually the remaining invested capital. So after that 5-year investment period, you have what's called the harvesting period, where you're harvesting your investments. So you're like starting to sell companies, or you're starting to earn interest, or you're starting to get dividends out of the companies. At that point, you're now not getting off of the committed capital. You'll have 1 to 3% of the invested capital. So say year 7, we've sold half of the companies, and we only have half of the investments out there. We'd get half of what we were getting under the committed capital portion, the investment period. Then the second portion of your return, or your economics as a private equity group, is carried interest. And hopefully this is a majority of your economics when it comes to being an owner in the private equity group or the general partnership. So what that is typically 10 to 30% of the returns above and beyond what's called the hurdle rate. So the hurdle rate usually in our industry is 7 to 8%, and that is an IRR metric. So that's your return from whenever you call the capital to when you sell a company. That can be on a deal by deal basis, and it can have a catch up, or it can be European style. So it just depends. There's a lot of nuances there, but essentially, let's say it has a catch up. If you return, say, 10% IRR throughout the life of the private equity fund, and your carried interest is 20%, the general partnership will receive the incremental 2% beyond the 8% if there's a catch up. So those are the two ways that private equity funds make money in terms of the general partnership and the management company. And so there's something called a J curve. So this is kind of the terminology that you'll see in venture capital as well as PE, which at the beginning of the fund's life cycle, you're losing money. Your IRRs are going to be negative because you're calling capital and you're making investments into companies, as well as trying to cover your management fees. So your internal rate of return is going down because you're not receiving money out of your investments to cover the losses that you're having because of the management fee being pulled out. So that's what's called the J curve. And then once you start getting into the growth and harvest portion of your fund, which is typically after 5 to 7 years, then you'll start to reap the benefits of having a higher internal rate of return as you start to sell off the companies, or do dividend recaps, or capture a bunch of interest. So yeah, that's typically what happens. Is you'll have a negative return up front, and then you'll start to excel after that. So from there, I wanted to talk a little bit about deal candidates. So who's an ideal company for being private equity backed, and then we'll talk about the process of going from a teaser all the way through to a deal being signed. So what we're looking for is a moat. You've probably seen most of these if you've studied PE. So we're looking for a company that has characteristics that are difficult to replicate. So like someone that can easily come into the industry and just dominate and take market share from you. That would be a difficult company to back because it makes it riskier. And it also puts a lot more emphasis on the ability of management to continue to innovate, which obviously is a good thing, but it's something that's difficult for management to do. From there, and it has to do with the moat, is you want steady cash flows. So you don't want to be in a volatile industry that you have, like, say your cash fluctuates a lot, but on average you make a lot of money. But your cash is fluctuating a lot. That doesn't look great for a private equity fund to back, because often private equity funds will put a lot of leverage on a company. So that's your senior debt and your subordinated debt. And those require almost always to have current interest. And that's interest that the company has to be paying monthly or quarterly, as well as amortization of that debt. So you have to have strong and steady cash flows throughout the life of the company to be able to meet that interest that is kind of native to the private equity deals. Likewise, it gives you ability to kind of budget any expansions without having to put in extra capital, which will kind of dampen your returns. And like we talked about earlier, we're looking for a strong management team or a strong succession plan. And I think we dived into that a little bit earlier. So moving on to the industry tailwinds is kind of the fourth thing that we're looking at. You don't want to be in a market that is shrinking, because what that means is the managers have to be able to not only just grow with the industry, but you're also looking to expand your market share, because your total addressable market is shrinking. So the only way to grow is to take market share from others. So we're looking for a company that's in an industry that looks like it's going to be growing over the next 10 to 15 years, because it makes it a lot more kind of backable and less reliant on the management team, even though that's kind of a sweetener on the deals that we're looking at. So in terms of the deal process, let me see if there's any questions. It doesn't look like it. So for a deal process, the way that it'll start is with a teaser. So that is an investment banker will send you over kind of like a one-pager that talks about the deal, the company that's looking to have capital or a liquidity event, and it'll give you kind of a little overview of what the company does, of what industry that it's in, a summary of their financial history. And then from there, they'll ask, are you interested at all in this opportunity? And if you are, you'll sign an NDA, so a non-disclosure agreement. So you can't go say, hey, Jimmy's dad's selling his company or something like that, right? It keeps confidentiality between the private equity groups and the investment or in the companies or sellers. From there, once you execute that NDA, you'll receive something that's called the SIM, and that's the confidential investment memorandum. And that's more of a detailed look into the company. So it's the teaser just on steroids. You'll see like a lot more detail when it comes to the industry, a lot more detail on the management, and you'll finally get the name of the company. So you can Google them, look at their webpage. And then they'll also have a lot more detailed financials and what their plan is moving forward. If you still like the company at that point, you'll start to have calls with investment bankers, potentially management, but likely not, just to get a better understanding of the company and how to price the deal. And then from there, if you like the company still, you'll submit what's called an IOI, which is an indication of interest or a term sheet. And what that is a kind of overview of how you look at structuring the deal. So what the enterprise value or enterprise value range that you're looking to make the investment, how you're going to back it. So whether that has to do with senior debt, sub debt, because they want some kind of security that you can actually do the deal. And then you'll submit that to the investment banker. So the investment banker will then go and talk with his client, which can either be like the seller or the company itself. And they'll make a decision as to whether they like your bid or not. I see a raised hand. Okay. So if they like your IOI and they think it's competitive, they'll invite you to kind of the next round where you'll get more detail on the company. Occasionally they'll open a data room and you'll see kind of the contracts and stuff like that you have to dig through to make sure that the company is like real. They're not misstating like the EBITDA that you're applying multiple to. And you also get to meet the management team, which is key when you're looking at making the investment for all the reasons that we've talked about previously. So once you meet the management team and get a better understanding of the business, then you create what's called the LOI, so letter of intent, and that's kind of the letter that you're going to submit to the bankers or the sellers that outlines more in detail than the IOI, and it'll tell the bankers and the sellers that, hey, we want to complete this deal. This is the enterprise value that we're looking at. This is how we look to structure it, and this is what we need to complete from now until actually making the investment, to be able to kind of sign the legal docs and transfer the assets or make the equity investment. So you'll submit the LOI alongside all the other private equity groups or corporations that are submitting LOIs, and the management team or the sellers and the investment bankers will then go from there and decide, hey, which of these LOIs do we like the most? Typically, they're looking for whoever the highest bidder is, and they'll select whoever that is to move on to what's called due diligence. So if you're selected from that kind of batch of LOIs, you move on to due diligence, and you're the only one that's going through due diligence at the time. And what that looks like, it involves all those parties that you see there to the right. So that's your, you have the company, you have the sellers, you have the investment bankers that have been kind of running the process and interfacing with the private equity groups as well as the sellers. And then you'll have consultants who will often do, say, like an environmental review of the company's facilities, just to make sure you're not getting into something that could cause harm to the environment, as well as kind of pose a lot of fees. So you'll hire consultants to do that, as well as sometimes do like an industry review if you're not too familiar with the industry and want to make sure that there's like a second pair of eyes on the company, so that you're actually making an investment into something that's going to grow and going to do well. Other parties involved are the lawyers. The lawyers will be drafting the legal docs and kind of going between themselves, talking about kind of the structure of the deal, all the legal terms between you and the sellers. And then you'll also have the accountants who will do a quality of earnings, and that's essentially a deep dive into their financials, making sure that everything that's been reported actually makes sense, and that you're buying a company based on the EBITDA that's actually advertised correctly. So occasionally you'll also have independent sponsors who will kind of go through this whole process, but they don't have money to do the entire deal or any upfront. It just depends on who the independent sponsors are. And they'll get through the LOI phase or the IOI phase and then reach out to private equity firms like ourselves for backing. So they'll get all the way through and then they'll say, hey, we have this company into LOI. Are you interested? And then they get a cut of the deal typically, and then as well as carry, which is similar to the carry to interest portion, but just lower down on the ladder. So it'll be directly into the investment, and then from there, the private equity group gets a return. And then you'll have the private equity firm and any of the co-investors that are co-investing inside or on the side of the private equity firm. So you conduct due diligence. Let's say everything looks good. Then you'll draft, negotiate, and then sign the legal documents that will be binding, and it'll transfer all the money will flow between the entities, and say it's an asset purchase. Now the new entity will own the assets, or the new entity will own the equity if it's an equity deal. So that's kind of the whole deal process. I think after this, we're diving into the actual model. But is there any questions on the deal process? I think next week the investment banker might be going in a little bit more.
There are two questions. So the first one.
Yeah. Okay. Am I right in assuming that entry-level analysts are involved in all the steps of the deal-making process? What does job market look like for entry-level analysts in private equity? So that's the answer to the first question is dependent on the firm that you're at. At CVF, we're involved in all of it, but that's probably because we're like a smaller firm. So at one of the bigger firms like KKR, you're probably just in the background, kind of digging into the model and creating the model, the financial model, which we'll dive into in a second. You're probably not interfacing with the management teams, and you're not. You may be crafting the IOI or giving kind of the structure behind it, but you're not the one actually interfacing all too much with the investment bankers either. What does the job market look like for entry-level analysts in private equity? Again, I'd say that depends on the stage of the company, or like the where they fit on the ladder of the private equity landscape, as well as just the industry that they're covering. So if they're like, say, if it's a private equity group that's focused like absolutely on like transportation, that wouldn't be likely a company that's hiring right now. But when it comes to like say technology or just typical lower middle market, I think there is room for entry-level analysts in private equity at the moment, given we're highly focused on our existing portfolio, and that takes a lot of time and effort out of the analysts at the lower middle market, and it also leaves a lot of opportunity for you to look at new deals that potentially could come through, given a lot of companies are struggling right now and looking for investors. What stage does a typically falls through? I think what you guys are asking there is, at what stage would the deal process fall through? So I'd say a majority of it falls through at the teaser level, or at the sim level. We probably see upwards of 300 deals annually, and we'll submit maybe 13 IOIs, but we'll see like 300 teasers or 200 sims. So that typically where it falls through. And then you'll have also on the due diligence, occasionally you'll just kind of dig into the contracts, or the QOV won't look good and the deal will fall through at that point. So that's typically where it falls through.
There is one more question. So is it currently a seller's market or a buyer's market? And also, does a PE firm take an equity position in a target company?
Yes, you take an equity position in the target company. Is it a buyer or seller's market?
As currently.
The dynamics now, I'd say it's probably, and I'm probably going to eat my words, but it's probably a buyer's market, given just how fragile the system is right now and how much struggle there is in terms of businesses having a lot of cash issues, or revenue declines or anything like that, and needing investors. But there's also like $3 trillion, $2.5 trillion is the latest that I read in private equity dry powder, which is just investment capital that's still sitting, that's committed but hasn't been invested. So I'd say it's probably a buyer's market, but the fact that there's so much capital sitting on the outside could kind of skew it a little bit towards the seller's market. Okay. So what are the sources of returns for an investment? There's two that you really want to focus on when modeling out the income statement, and that includes your revenue growth and your margin / cost efficiencies. So when it comes to revenue growth, that's going to be kind of the dictator of how fast you grow the company. So let's say your margin stays the same, but you're growing at 10%. Your investment is going to do very well because your top line is growing. You should have some operational leverage, meaning you don't have to increase your SG&A as much as you grow. So like say you double, you only have to add like 50% more staff. You don't have to add 100% more staff. So revenue is the metric that you want to focus on, because it also, you can either increase so when you're looking at revenue growth, you can either increase your scope or you can increase your scale. And your scale would be, say, just growing naturally within your vertical that you're currently selling to. Scope revenue growth would be like adding new product lines, right? So if you're a tire manufacturer purely, increasing your scope would be like selling rims or different car parts or something along those lines, instead of selling more and more tires.
I did want to tell you, it's 3:28. So if
Oh, okay, yeah. I'll move quicker.
yeah,
Sorry about that.
No,
So margin efficiencies, you want to increase. Technology helps you get some data points around your margins and make sure that you don't have any inefficiencies when it comes to your margin, which means for every incremental part that you sell, you're making more money on each one. And you don't want it to go down. So you want it to increase, so that your net income goes up as you scale. Leverage, like I mentioned, that's your senior and your subordinated debt. So the more senior and subordinated debt that you put onto a company, the less equity that you have to invest into the company, which will push up your returns if the investment goes well, because you have less equity investment. But it also increases your risk, going back to the point where you have to meet your interest coverage. So it increases your risk, but it also magnifies your returns as well as your losses. Multiple expansion. So that's essentially you enter the deal at 5 times EBITDA, and you're exiting the deal at, say, 7 times EBITDA. You gain that arbitrage in the multiple entry and the multiple exit. So with that, we'll kind of jump into basic private equity model. So let's just go through this example really quick and keep it in mind. So ABC Tire Company is a tire manufacturer that owns 100% of Sally and John Smith. They're looking to sell a majority stake in the business to secure their retirement, which they expect to be in 2 years. So that tells you have to be looking for a succession plan because they want to retire. And you also want to make sure that they're okay with someone taking over, or if they have a succession plan, they're willing to teach the individual how to run the company. The consumption of tires is expected to grow at 2% above the GDP for the next 5 years, and the GDP is expected to be 3%. That would be great. So that tells you your revenue growth on your base case is going to be 5% annually for the next, say, 5 years. The cost of rubber is expected to remain steady over the life of the investment. So let's make the assumption that the only component of your cost of goods sold is rubber. So your cost of goods sold as a percent of revenue is going to stay the same throughout the investment. The company has historically generated $35 million in revenue and $5 million of adjusted EBITDA annually, and on average spends $1 million on maintenance CapEx. So maintenance CapEx is just kind of what you have to spend on your equipment to make sure that you have the equipment base and make sure it's good to go in terms of creating the products that you create. So you subtract out maintenance CapEx out of adjusted EBITDA to get to a closer measurement of your free cash flow. So I'll turn over to the model real quick. You guys can still see my screen, right, Brahim? Yeah.
Yeah.
Okay. So we'll turn over to the forecast and assumptions tab. I've already pre-filled out your guys's, or the revenue for ABC Tire Company over the last 4 years. And you'll see their averaging cost of goods sold as a percent of revenue of 75%. And on average, they're doing 30 million with $5 million on average of EBITDA here. So your SG&A is about 3.4 million annually, and that translates to about 11.5% of revenue. So to build out the income statement, which is going to be your first step in modeling out the business, you want to project out revenue growth first. So here are the different revenue growth scenarios. So you have your down case, your base case, medium, and management case. And that's going to dictate what your top line revenue growth is moving forward. So under the base case, your revenue is growing at 5% annually.
Do you mean to screen share the PowerPoint only, or is there something else that needs to be screen shared?
Oh, are you guys not seeing the model?
Yeah, sorry about that.
No, thank you. How do I transition over new share? Okay. Sweet. Thanks for catching that. Okay, so now you guys see it?
Yeah, definitely can see it right now.
Okay, cool. So I was talking about the revenue and the cost of goods sold and everything along here. Everything in green is is a hard code. Everything that's not in green is a formula. So you'll see here, down here is the assumptions that you're making. So you have your down, base, medium, management case, and that's essentially a toggle. So you can toggle between different cases. So everything here dictates the income statement through EBITDA moving forward. So the assumption right now is that your revenue growth for the next 5 years is going to be 5% annually. Your cost of goods sold is going to stay steady at 75%. And your SG&A as a percent of revenue is also going to stay relatively steady, but you have a little bit of scale moving forward. And your depreciation and amortization as a percent of revenue is also going to stay pretty steady, even though that won't impact cash flow. So all those flow up into the income statement. I think you guys probably understand how that flows in. So all this is your assumptions in terms of the income statement. Now we'll click over to the LBO tab, which is your leverage buyout is LBO. The first step after completing the income statement, so you'll see it kind of regurgitated here, is to figure out what the enterprise value of a company is. So let's say the company is doing $5.2 million in EBITDA, and they spend $1 million in net capex annually, and you're going to apply a 6 times multiple to the free cash flow. So if you enter 6, you'll get an enterprise value of $25 million, which the enterprise value is the entire capital stack of a company, and there's nuances with ARAP and everything like that. But your enterprise value tells you the total worth of the company. From there, you're going to subtract out your net debt. Let's say there's $10 million of senior and sub debt on the company currently, and that'll get you to your equity value, which is the value of the equity shares in the company outside after taking out the debt from the enterprise value. So we're going to do an asset sale, an asset purchase. So if it wasn't an asset purchase, you'd just be focused on this equity value portion here, but we're going to buy the entire enterprise and switch out the debt essentially and increase the leverage. So you now have your equity value here, which is the equity value that the owners own currently. And like we mentioned, they're looking to take some chips off the table. So they're going to retire 70%, let's call it 80% of their current holdings. So that means that the owners of the company are going to get stroked a check worth $12 million at the close of the deal. And they're going to roll, which means invest into the new company that's created, $3 million, which when you add these together, that is the equity value of the company. So they're rolling a portion of the equity and they're getting cash for the other portion of the equity. So now that you have kind of your entry equity value, your entry enterprise value, and you know how much cash that you need up front for the equity, we can kind of turn over to the sources and uses portion, which is you have all these uses of cash that you need to put in, which would be like the equity value as well as the sub debt and the senior term debt that's currently on the company to buy those people out. So your uses are going to include all that, as well as some transaction expenses, because it costs money to pay for those lawyers, those consultants, and everything that goes along with completing a deal. So you'll see that number here in the 506. Let's say it's $500,000 to complete the deal. That's going to be another use. So you'll see here, this is a plug that essentially tells you, hey, you have no sources other than the common equity role to meet the obligations of your uses. So let's go through the capital stack and assign some capital to the senior term to be able to meet those uses. So they're doing $5 million in EBITDA annually. A senior lender would be willing to do, let's say, 2 times EBITDA. So let's do like 12 million. It's a little bit more, but we can do that. Okay. And so now you can see you still need $10 million of either sub debt or preferred equity to meet the obligations of your uses. So going through, we'll skip that. We can go in and let's say the sub debt right now, your total leverage is 2.3 times through your senior debt, which is your senior debt divided by EBITDA. So that's your leverage through the senior debt. You could probably lever the company up to like 3 times. So let's put sub debt of let's say 3 million. And so that'll flow into your uses here. So now you still need $7.7 million of capital into the company. So that'll come from your preferred equity investments. So you have, let's say 8 million, just so you have extra cash in the door. I don't know why I keep on putting an extra 0. But that'll get you through your sources and uses. So your sources, you have a total sources of 26 million. You have a total uses of 26 million. Those have to match, and the plug will be your working capital. So any excess cash that you're going to invest into the deal will just go into working capital. So that gives you your sources and uses in the deal. So this sources is essentially going to be your balance sheet when it comes to the capital stack going into the deal and post-close. So now from there, now you know you'll have $12 million in senior term debt, $3 million in EBITDA or in subordinated debt, and $8 million in preferred equity. So now you have to make assumptions on the terms of those sources. So let's say your senior debt typically will carry, let's say, a 6% interest, current interest on it. Your amortization is going to be over 7 years. So amortization is just how long it takes you to pay off the principal on the debt. So you're going to amortize the $12 million over 7 years. So you're going to be making payments of like $1.5 million annually on the senior term debt. And then on your subordinated debt, let's say the current interest rate is 11% and PIK interest, which is what you accrue annually instead of paying upfront, is 2%. And you're also going to amortize it over 7 years. So you're going to be paying like $420,000 a year down on your principal. And then sometimes you'll have a seller note, but we'll skip that because we're running late. Preferred stock will typically carry a PIK interest or PIK dividend rate, which is essentially, like we said, it's accrued onto the balance of the preferred stock, but it's not actually paid out unless the company has the cash to pay it out and elects to pay it out. And then you have your common stock, which carries no PIK rate and no cash rate. And so that'll flow into here, which is your essentially cash uses for your capital stack. So your senior debt, you started off with 12 million, and like we were saying, you're paying about 1.5 million annually on your principal. So your principal is going down to 5 million over time. And same thing with your sub debt, just at a higher interest rate, and your PIK, which you see is accruing onto the balance of your closing of your subordinated debt. Your preferred also is getting the PIK dividends that's accruing onto the principal of the preferred stock. And then you'll see down here your cash payments below your EBITDA. So your EBITDA will tell you how much cash is the company generating prior to paying out the interest as well as the principal payments on the debt, as well as your financial leases, but there is none here. And then also how much you have to pay for your CapEx. So your excess cash pre-tax will tell you that number. So you subtract off EBITDA minus your total cash payments, and that'll get you the cash generated pre-tax for the company And then you have to subtract out taxes, which is right here, which is essentially just the pre-tax cash multiplied by the tax rate. Actually, that's not true. You can only subtract out the interest rate or the interest payments, not the principal, because you can't. That's not like a tax shield. So from perspective of your ability to pay those payments when it comes to principal and interest, you want to make sure that your fixed coverage ratio is at least above 1. 1 would be bad. Anything below 1 is very bad. So you want to be above 1 times, which that means is your EBITDA, the cash that you're generating from the company, is able to meet the obligations that you're having to pay out on in terms of the debt. So another metric that you want to track is your debt to EBITDA. You don't want that to grow too much because then your fixed coverage will get out of whack a little bit. But you see this going down because your EBITDA is going up and your principal balance on your loans is going down as well. So your debt to EBITDA is going down. So over time, you have to keep track of your cash generated because that'll be on your exit waterfall. So turning to the exit waterfall here, you want to back into the enterprise value, similar as we did to the entry purchase price. We're gonna have to dictate what the enterprise value of the company is that a buyer is willing to pay for the company, and then obviously subtract out the debt to get to the equity value that we are a current holder as a preferred investor. So you'll see we'll just apply a 6 times multiple, no multiple increase to get an enterprise value of 32 million. You subtract out the debt, you add back the cash, and then you subtract out all your debt to get, and all the payments that are out to the preferred equity to get to the equity, the common equity value, because the preferred equity has a stake in the common equity, dictated by the level of investment that you make, and the amount rolled by the previous owner. So you'll see here, the ownership post-close is 27%, legacy owners 72%, the new investors. And often the new investors will take a discount to their investment because they're above the common equity holders, which would be the owner 1. So let's say our preferred discount is like, say, 20%. You'll see that the capital stack, the ownership of the common goes down for the new investor because they're kind of giving the common equity holders more equity, just given they're below the preferred equity holders in terms of a liquidation preference. So when you exit, you have your equity value here, and you dictate how much each of the owners gets of that 21 million, 22 million, based on the ownership of the common equity, because you'll see the preferred equity already got paid out because of their liquidation preference. So you'll see the exit cash for the new investors and the legacy holders, and now you have all the cash flows that you need to kind of flow into your returns. So you'll see down here, you'll see the returns of your investment. So your subordinated debt is getting cash interest annually, as well as principal payments annually, and at the close of the deal, second close of the deal, and they're driving these cash flows here. And based on those cash flows, you run an IRR function, which is essentially what return did you create on the amount of investment that you made. And you'll see they're driving 12% returns, and the preferred equity holders, again, they got no cash dividends because it was PIK. So that means that you're accruing it onto the balance of onto the principal balance of your equity investment. And they get a liquidation preference before participating in the common equity. That's what preferred equity is participating preferred in this case scenario. So they get their liquidation preference and their equity share there. And that's what's driving their returns of 26% on the preferred equity. And when you blend those together, you get these cash flows here, and that'll drive your IRR 25%. So I'm sorry I ran through that very quickly. I just didn't want to keep you guys too long. But if there's any questions, now is kind of the time to send them in. Could you provide a good resource for LBO modeling and forecasting? Sure. Yeah, I'll send it over to Michael or Brahim, and they can send it out to the group. So
Right.
any questions in terms of modeling or say like my role or private equity in general? Happy to answer any of those.
We had a question. Could you provide a good source of LBO modeling and forecasting?
Yeah. So I'll send that over to Brahim or Michael or you, Leon.
Sounds good.
Get
Just making
around.
sure. All right. I think that summarizes. Oh wait, we have a question right here. Yeah. What is the typical career path for PE industry?
Yeah. So the typical career path to getting into PE is you'll do, say, like 2 years of investment banking. So you get an understanding of the different reasons for investing and what private equity investors are looking for in their investments. And then you'll transition over to the buy side, which is on the private equity side, running the investments and working alongside the managing partners to learn. And then you'll kind of move up from that analyst role through associate, through VP, and then maybe you'll start your own fund or you'll get invited into the general partnership.
There is another
or you can exit, right? You can leave PE because now you have this operating experience in terms of working with the management companies, and now you can, or the portfolio companies managers, and you can go and maybe start your own company, or you can go and be like kind of a manager inside of a company.
There's another question where do you see yourself in the next 5 years in terms of your career, especially how your current role is helping you reach that goal?
Yeah, I'd say that ladder that I just explained is kind of my goals, is to kind of move up in terms of within the private equity space. So moving from an analyst to an associate, up to VP. That's the transition that I want to make over the next 5 years, and kind of leading more, I guess, decision making behind the capital allocation.
And another question is, do people transition into corporate M&A from PE?
Yes, that is very common. So corporate M&A is a very common path out of both investment banking as well as private equity, because you understand how deals work. The difference would be you have to have a really good understanding of how the company that you work at functions, so you can understand what the synergies are with potential acquisitions and tucking those into the company that you work at. So you're taking not really a holistic view on the market, you're taking more of a company specific view. But it's definitely a trajectory that happens from both investment banking as well as private equity.
And there is another question, I'm not sure if you've answered it, but what is a typical career path in PE industry?
He's answered that.
Okay. Yeah, I think I covered that one.
That's okay.
Okay.
So Ben, I have one quick question for you, and I kind of private messaged it to you, but I know that this is an Excel spreadsheet. Is this like a template, or do you have, for every deal that you do, you start from the beginning and add pieces? Because I can tell you, man, whoever did this one really knows Excel. It's like, my God.
Yeah, to answer your question, Michael, at the IOI phase, so if you guys remember the deal process, at the IOI phase, at least at CVF's level, we'll run a model based similar to this template. I tailored it a little bit, but on a deal by deal basis, at the IOI level, you'll usually use something similar to this. Obviously, depending on the deal, you'll want to tailor it. So whether there's like an independent sponsor in the deal, you'll have to model that out. If there's some kind of equity ratchet in the deal for the management team, you'll have to model that out. Some kind of escrow, which is something we didn't touch on, you'll have to also model that in. And so yeah, I mean, in general, at the IOI phase, you'll use a template, tailor it a little bit. And then once you get to the LOI phase where you're really digging into the company, you'll build a much more detailed from scrap model.
Wow.
And that'll be very specific to the company.
So Ben, do you use, I hear a lot of these different financial programs. Do you use Python there?
No, we do not. No, but we'll use VBA, which is kind of like the Excel version, or like the Excel programming portion of Excel.
Okay.
But no, we don't use Python. But I know more in like, say, like the trading portion of like the public markets, they'll use a lot of Python. Yeah. Okay. It doesn't sound like there's any other questions. So I'm pretty sure this is going to be up on LinkedIn. The Street Smarts on LinkedIn, and they'll be posting it. And then also, if you have any questions specific that I can answer, if you guys want to get on a call just to discuss something more in detail, happy to do so. So yeah, Michael has my contact information if you want to get a hold of me.
Yeah. So Ben, thank you so much. I know Brahim's gonna wish it all goodbye, but man, boy, you've learned a lot since you were with me. But I'm proud of you, buddy. Okay.
Yeah, thank you, Michael. I appreciate it. There's a lot
I know.
we can
Well,
cover,
we're gonna have you back. We're gonna be doing a lot more things,
Great.
Ben. So I really appreciate you, and I appreciate your firm being one of our sponsors. I mean, we talked about when you were with me about paying it forward, and here you are doing it. So
yeah.
Anyways, man, Brahim, it's all yours. Ben, see you, buddy.
Yeah, thank you, Michael. Thank you for having me. I really appreciate that.
I wanted to thank everyone for coming in, and thank you, Ben, for presenting this model as well as
a big thank you, Ben.
equity.
Of course, yeah. Let me know if there's any way I can help as well. Okay, thanks everyone.
Everyone.
Appreciate it.